Welcome to our video covering bonds. And look, before I go further, I know bonds are not the most exciting asset class, but they play a key role within a portfolio. So in this video, I'm going to show you what they are, how they're used, where they fit in the capital structure. I'll then move to some of the risks that we face investing in bonds, and I'll finish by talking about how they interact with the portfolio, particularly how they can be used to diversify some of the equity or stock risk that many investors carry within their portfolios. Let's dive into this. Let's start by talking about what exactly a bond is. When a company or a government issues a bond, they are raising capital and they're doing it through debt. The buyer of that bond is not getting an ownership or equity stake. They're making a loan to the company or government. In exchange for making that loan, we hope to get a stream of interest as well as repayment of principal, usually at maturity in a lump sum. There are some other structures, but that's the typical way it's done. There are a number of different types of bonds. I want to touch on a few as we look at this capital structure. So we have secured and we have unsecured bonds. The key note here is that secured bonds have a specific asset assigned as collateral in case that deal goes south. The bondholders will have the right to actually take that collateral to secure their position. Unsecured obviously does not have that. Subordinated bonds are going to be junior to both of those, and in the case of a bankruptcy or default, they're only repaid if there's enough capital to take care of these two first tiers. Then what's left will flow to the subordinated bondholders. So we've covered what a bond is, where it fits in the capital structure. Let's move forward. So I just mentioned that it's usually companies or governments looking to raise capital through bond issues. I want to share a few common bond types with you and comment on each one, just a line or two to give you an idea of what that category may bring. So first we have U.S. Treasuries. U.S. Treasuries are considered some of the safest paper available in the marketplace. They're backed by the full faith of the U.S. government. Then we have municipals. Municipals are going to be smaller governments within the U.S., and this can range from county to state governments. It could be a variety of local projects. In exchange for investing in municipal bonds, investors do get exposure to some tax advantage benefits. Foreign governments also need to raise capital for various purposes, and the range here in terms of credit risk can vary widely. So you could have a very credit-worthy foreign government, or you could have perhaps an emerging economy with much more credit risk. So there's a spectrum there to be aware of. We're moving on to the corporate bonds. We have investment grade and we have high yield corporate bonds. So on the investment grade side, these are going to be established blue chip companies, and the bonds themselves are typically structured high within the capital structure. The high yield bonds are going to be riskier in a sense of they're carrying more repayment risk, more credit risk. It may be because the issuer is less established or less stable. It may be because it's a junior or subordinated bond within their structure. Last, just to comment briefly on convertibles. These are bonds that, in addition to interest and principal repayment, offer the option to exchange for an equity ownership in the company that you've lent money to. Bond investors face two key types of risk: credit risk and interest rate risk. Let's start by taking a look at credit risk. Rating agencies have a huge say in how investors perceive the credit risk of a given bond. They assign a rating, and from there, bonds can be categorized into two broad categories. We've placed a line between investment grade and high yield bonds. I'll note here that junk bonds and high yield bonds refer to the same category typically. They can be used interchangeably. Now, as bonds move down this credit spectrum, investors typically demand a higher rate of return because they are taking on additional risk. Therefore, the company typically has a higher coupon or payment rate on those bonds. It's not inherently good or bad to be high or low risk, but this is one of the factors. So when you're using bonds within a portfolio, you want to be aware of how this credit risk relates to your bond holdings and to the overall portfolio that you're using this with. It's equally important to understand interest rate risk when you're investing in bonds. First, note that bond prices move the opposite direction as interest rates. When rates rise, bond prices move lower, and vice versa. The amount of price movement you can expect can be measured through a statistic called duration. Duration is different than maturity. It's the weighted average of all cash flows over the life of a bond. If you look at how that impacts price movement, notice that the further out you go in duration, the more price movement you're going to experience in the bond position. Now that could be something you want to mitigate and keep duration low, or it could be something you intentionally want for some other portfolio reasons, and you may choose to have duration in your positions. Just depends on what you're looking for. Note that the opposite's true. If rates fall, bond prices can go up, and I want to speak about why this happens just briefly. If a company issues a bond at 5%, that bond nominal rate of 5 doesn't change for the life of the bond. It's a rigid instrument. Let's say market rates now increase and rates are at 6%. In order to entice investors to buy that bond in the secondary market, the price has to fall. And if that company wants to raise new capital, they're going to have a tough time raising it at 5 if the market's demanding 6. So bond prices and interest rates are very closely connected as a result. So what we have here is a chart that shows various types of bonds, and on the x-axis you're looking at the correlation between that bond and stock prices. On the y, the yield that that bond offers. So let's dive into this and look at how these interact with a portfolio. On the right, you'll see convertibles. Not surprising, very high correlation with stock price movements because convertibles can be exchanged for stock. We also have U.S. high yield carrying quite a bit of risk. On the left-hand side, you'll see many of the higher quality government bonds, including the U.S., Germany, Japan. These are countries that offer low credit risk, and in exchange, they can be used to diversify some of the stock risk within our portfolio. I want to note that each bond carries credit risk and interest rate risk to some extent. Be intentional on where you position yourself. Be aware of where we're at in the economic cycle, what's going on in the interest rate landscape, and equally important, understand what you own in the other pieces within your portfolio so you can add the right mix of bonds to complement and properly diversify your overall portfolio.